for more than 12 months, it is considered as long-term taxation. For less than 12 months, it is considered as short-term. For equity, the taxation rates, as we all are aware, and probably most of your investors will be aware, for more than 12 months, if you own, then you pay 10% plus cess. For less than 12 months, you pay 15% plus tax cess. So that's essentially on the equity mutual fund side. Now, other than equity, right? Other than equity, be it gold, which is a commodity, we shall soon have silver ETFs with the regulations soon coming in, or be it debt ETFs, or sorry, debt mutual funds, be it debt-oriented ETFs, be it international ETFs, right? In international fund of funds also, I think there is a flavor of people investing outside India as well. So anything other than equity, the taxation is as follows. You have to hold it for 3 years for you to get the benefit of long-term capital gains. If you hold it for less than 3 years, it will be added to your income and you will be taxed at the marginal rate. But if you hold it for more than 3 years, you basically get the benefit of indexation. That is, your cost increases with the RBI's published cost inflation index. And on that increased cost after 3 years, whatever is your capital gain, you will be paying 20% on that. So obviously, at 20% is also a reduced rate compared to most people's marginal rate would be investing, and you get the benefit of indexation. So I think it's a very competitive way of investing because you're getting the benefit of indexation and you're paying only 20% long-term capital gains tax post-indexation if you hold it for 3 years. So this is essentially what the taxation of gold ETFs and gold fund of funds would also be. Your long term will be more than 3 years, and if you hold it for more than 3 years, you get the advantage of indexation and you get taxed 20% on your indexed cost of acquisition.
Okay, got that. So basically, you hold it for 3 years and more, and then the taxation becomes more favorable. Chintan, what's the international experience telling us? I mean, I'm sure gold ETFs have been prevalent internationally far longer than they have in India. And how has the experience been? Is this really the proven route to invest in gold?
So, gold cycle in the last 10 years, Surbi, has been benign, if I may use the word, and hence you haven't found gold ETFs garnering a larger part of the AUM. The current fashion for investment is other commodities. Crude has been rallying significantly, so that is gaining money. And most importantly, it's essentially equities which are garnering money. You're aware that I think passive funds and ETFs garnered about $1 trillion in equity AUM globally. That's a significant addition because equities as an asset class in the last 10 years, courtesy interest rates being lower, have done exceedingly well. And so a large part of the flows have moved towards equities. With debt interest rates coming down, I think debt as an asset class has probably gotten lesser attractive. Gold is an emerging asset class. There are other asset classes which probably we do not have access to as a mutual fund, and we do not. I mean, it's not something which we have products around, but that is also garnering a lot of money. But gold, last 10 years has not picked up. It just picked up in the last 1.5 year after lockdown in India, when it had that rally from 30,000 to 50,000 odd or 56,000 in August 2020. After that, again the gold flows have slowed down. But what we believe from an investor standpoint is that you have to look at last 10 years returns. If the last 10 years returns in any asset class have been poor, you have to believe that if there is a reversion of mean, in other words, if the law of averages catches up, then that asset class can actually do well. It showed up classically in other commodities. If you look at other commodities or even Indian infrastructure stocks, real estate stocks, in the last 10 years, they probably didn't do much. And in the last 1 year, with the reflation rally happening, you saw commodities going up. Aluminium, copper, zinc are at probably their life highs. Gold, however, is obviously lower than its life high of $2,000 an ounce, which it touched on in August 2020. So our belief is that gold, which has been remained the reserve value today, is probably a fourth best preferred asset class after equities, debt, other such instruments which are becoming fashionable right now. But at some point of time, when there is a volatility in the market and raises itself for, or remains higher for a while, gold will come up. The numbers are quite startling. Actually, if you see 2011, the world market cap in equity to gold available, the ratio was 20%. So gold was 20% of the global market cap. Today, gold is only 10% of the global market cap. So gold has seen this kind of derating versus the equity markets. And today, a lot of the money is going into equity markets. Even a fraction of that Just to give an example, global equity market valuations are $110 trillion. The availability of gold globally is about $11 trillion. So even if 2% of the global equity market cap has to probably move to gold, that's a large amount of gold. And unlike equities or unlike printing of money, the gold production globally does not increase by more than 2 or 3%. It's not possible to mine gold out of thin air. So gold is a asset class which has limited supply, and hence its value will always be valuable from an owner perspective. And in a high inflation, this shows up. So we firmly believe that gold should be at least 5 to 10% of the investor's portfolio, given where other asset classes and their valuations are.
Okay, 5 to 10% of the portfolio. That's an important metric to perhaps keep in mind. Of course, Bitcoin became the gold of 2021. That's a separate conversation. But yes, perhaps worthwhile to keep with an asset class that has proven its track record over the last so many decades. Okay, we're getting some questions as well, Chintan. So I want to take this up. There's a viewer query where the viewer wants to know which is the best way to invest in gold. And this is an important question. We've omitted out the jewelry route because that's not really investing in gold. That's simply buying something for personal purchase. There are other avenues as well. For instance, there was this whole concept of digital gold, which several platforms were advertising. Some brokers were also selling digital gold, but I think now there's a regulatory cloud over that. So if you could, tell us, the other avenues and why perhaps a mutual fund route would still make sense for a lot of regular retail investors.
Fair enough. So I think just on your statement of whether jewelry is an investment, most Indian, uh, let's say, women who buy gold, they will say that they are best fund managers because for years they've been accumulating an asset class which has really good returns. So jewelry has its own value, but obviously the making charges take away the sheen. But the better way to invest, of course, sovereign gold bonds, which are issued by the RBI, are a good way to invest. They have benefits which are there for the investor. So if you are a patient investor for the long term, I would say sovereign gold bonds should be looked at. However, as part of an asset allocation plan, if investors want to invest in gold and want to tweak their investments in gold basis what the other markets are doing, then a more liquid and efficient way is to invest via the gold ETFs and the gold fund of funds, the wrapper which I mentioned, which help you to invest in gold ETF without the demat and trading account. So, for most investors, I would say gold ETFs and gold fund of funds provide you with easy liquidity. There is no limit to investing. There is no per person limit to investing as well. So you can invest as much as you want as an individual, and it is quite easy to manage because it all forms part of your one statement, which comes in which all your mutual fund holdings would also be there. So it's quite an easy route. So I would say that preferred option should be either the sovereign gold bonds, which are issued by the government, or the gold ETFs. In sovereign gold bonds, if your holding period is very long, I think 8 years is what they issue on. It may be looked at. And for those who are used or investing in gold ETF, either to trade in, trade out, or to manage their overall asset allocation, I would say gold ETFs and gold fund of funds are a more suitable option.
Okay, fair enough. So you can look at the bonds or you can look at the ETFs. You mentioned the aspect of purity, Chintan. I just want to spend some time understanding the safety and purity. Now, of course, even on physical gold, for instance, even in jewelry, hallmarking is becoming mandatory. Uh, how is the safety of the gold ensured when you're buying it in a financial form via a gold ETF? I mean, do these ETFs actually hold the underlying gold? If yes, where is it held? I mean, as an investor, I would just want to know how it works, how the underlying is also dealt with.
Yeah, that's actually the core of the product itself, and we should have probably spoken about it earlier, but thanks for asking that question. So essentially, when you're investing in a gold ETF, it is nothing but we collecting money from the unit holders, and buying physical gold and keeping it safe with custodians who manage or who hold that physical gold. Now that physical gold is also certified, gold, which is basically LBMA approved, and it is stored in the warehouses or custodians. And as you're aware, gold ETFs are also regulated. So there are regulations around what is the purity of gold which we can basically buy. And this is essentially generally the first hand gold which comes or is imported or is traded, and it is held in custodies where the fund asset management company or the manager of the ETF is paying the requisite insurance required for safety of that gold. So the end-to-end safety security is handled by the asset management company based on the rules and regulations which are defined by the regulator. And so effectively, while you are getting it in unit form in your financial investment, it is actually backed by gold. So every rupee which is received in the gold ETF is backed by so it's backed by physical gold. And the reverse happens when you basically take out the money, we will sell the gold in the market and give you the money. So yes, the packing of physical gold of highest purity is there when it comes to the gold ETFs. That's how the functioning happens of gold ETFs. And we have intermediaries or authorized participants who help us get the right quotes or who help us get the right rates for the gold which we are buying and selling. And it's all a very transparent process.
Okay. What about liquidity? I mean, how easy is it to trade these ETF units on the exchanges? And also redemption, if I actually want to redeem and get my sort of money back, then you said I think it takes what, 2 to 3 working days.
So typically in any mutual fund or in an ETF, for example, if you are investing in an ETF, the payout structure is T plus two, right? You sell any stock on the exchange on a T plus two working basis, you get the money. Same is the case with ETFs as well. And generally in 2 to 3 days, you would get the money. And that would also work with the regular goals or the fund of funds also. They have a 2 to 3 day cycle. So it will be quite quick in terms of you getting the money. The other aspect is, of course, that in terms of liquidity on the exchanges, uh, it is improving. The more the number of investors who come to the markets, who come to the exchange, liquidity begets liquidity. So it's a virtuous cycle. As an asset management company, the asset management company appoints authorized participants who ensure that on the exchange you have enough liquidity when you want to buy and sell. And in general, what we've seen is that the authorized participants do have quotes on the exchange, and if more and more investors do start coming on the exchange, the natural liquidity will ensure a very efficient uh, price discovery mechanism as well as execution efficiency for the investors.
Okay, fair enough. So as we're coming down to final thoughts, Chintan, I just want to go back to the point that you made about having at least 5 to 10% gold holdings in the portfolio. Now, is that a call you're taking based on your expectations from this asset class? Because you do see a 10-year sluggish phase reviving, or should that be a function of one's age and risk profile?
Yeah, so I think the asset allocation plan in general should be based on the risk profile, and the asset allocation plan should be based on what are your commitments, responsibilities. So each individual will have a different income stream, different inheritance, different responsibilities. So that asset allocation plan will be determined by either the investor or the advisor slash distributor who can help the investor to create it. But in general, what we see right now, I would say for most Indian investors, 30 to 40% in dynamic asset allocation plans, maybe 30 to 40% liquidity in the debt mutual funds, and 5 to 10% in gold, and 5 to 10% in international markets. That's the general trend which we see emerging, where most investors are comfortable in. Should or can gold be much higher than that? Also, it depends on how comfortable you are in terms of managing your emotions. Because last 1 year, gold has been negative. Maybe next 6 months, gold will be negative. If you have a very large exposure, let's say 25 to 30% in gold, and it kind of draws you down because your equity portfolio has gone up 60% in the last 1 year, gold has gone down 5%, and you end up moving from gold to equity at the wrong time, you may end up getting hurt or defeated. So, discipline and patience in asset allocation is very key, and hence a 5 to 10% to start with. And then as you keep booking profits in your equity portfolio, you may want to add gold and take it higher as well. So it's not cast in iron and stone that it should be 5 or 10, but I would say that having minimum 5 to 10% today makes a lot of sense given where the entire ecosystem in terms of valuations of debt and equity are.
Okay, Chintan. So as we're winding it up, what's the final advice you'd want to give to our viewers? Anybody who's thinking of taking the plunge and increasing their gold allocation this Diwali?
So, just to keep it simple, follow your asset allocation, keep yourself disciplined in terms of following asset allocation. And given where we are in terms of the global growth, global inflation, and valuations of equity and debt, with like Surbi mentioned, interest rates likely to go up and liquidity probably drying down, there will be volatility in the markets. And typically, we've seen when inflation is high, volatility in markets comes in. Gold becomes a good buffer for you in terms of, capturing or stopping yourself from getting hurt in the volatile markets, and also allowing you to participate when the gold rallies in an inflationary environment. So that's where the gold ETFs and gold fund of funds can be a handy tool for your asset allocation requirements in the current market setup.
Okay, all right, Chintan, got that. Thank you very much. I think very helpful conversation for everybody and anybody who is sort of thinking of looking at their portfolio more holistically. And I think we're at a very interesting juncture where perhaps gold will start ending its underperformance. So this is a very important conversation for viewers to keep in mind. Thank you for your time.
Thank you. And
दूसरा रन लेने की कोशिश, लेकिन ये रन आउट।
चाचू रन आउट।
कोई जरूरत नहीं थी रन लेने की।
इन्हें तो साथ भेजना ही नहीं चाहिए था।
कौन मैदान पर आता है?
अब अगला कोई एग्रेसिव प्लेयर आए तो सही होगा ना।
अरे अग्रेसिव तो खड़ा है ना स्ट्राइक पे भैया। कोई डिफेंसिव प्लेयर है तब तो जोड़ी बने।
लेफ्ट हैंडेड बैट्समैन की जरूरत है। लेफ्ट हैंड और राइट हैंड का कॉम्बिनेशन बॉलर्स को भारी पड़ेगा।
और ये कैप्टन का सही डिसीजन, लेफ्ट हैंडेड बैट्समैन की एंट्री।
सही जोड़ी ही मैच जिता सकती है। इसलिए जब हो आपका टैक्स प्लानिंग का मैच, आपको चाहिए टैक्स सेविंग्स और वेल्थ क्रिएशन की सही जोड़ी, जो आपको मिलेगी ELSS फंड के साथ। जब जोड़ी राइट तो फ्यूचर ब्राइट। ICICI Prudential म्यूचुअल फंड, तरक्की करें। Mutual fund investments are subject to market risks. Read all scheme related documents carefully.